Well, thank you, Mark, and thank you, everyone. This is the matinee session, and I wasn't here this morning to hear what the other speakers had to say, so you probably know where I'm going to come from, and it is one, from the heart, and two, what I obviously believe in, and number three, I hope you enjoy it. This last decade that we're just about to close the curtain on has probably been one of the most bizarre but most unusual in my 50-odd years of experience in the financial markets, and I suspect it probably has been the most unusual and unprecedented for maybe a century. You heard the saying that time heals all wounds, and there's no doubt about it that it does. In fact, only 5 weeks ago, someone cut a nice slice down my left-hand side, and all I can say is that in 5 weeks it's all healed. But, you know, what we've experienced over the last 12 years, let's say 2007 through to 2019, as I said, has been unprecedented. And you know what has made it that way. Central banks persistently being very, very highly active by stimulating global economies post the GFC, ever cutting rates and ever printing money to the point of extreme, in my opinion. The topic of my discussion is the next decade won't be a repeat of the last. A paradigm shift is coming. And paradigms, you know, are patterns, and we've had a pattern that hasn't been changed now for 12 years, and that's unusual because we usually get a decade cycle, if you like, and there is a flush out of excesses, whether they're at the bottom or the top. And yet the central banks haven't allowed that flush to happen because they think it's their job to prevent an economic contraction and extend it whatever it takes. Well, my gut feel is that that is unsustainable, and that's why I think that this is not a sermon from the Mount where repent, you sinners, because it's all going to end. It's more Boy Scoutish. What was that guy's name? Baden-Powell. Be prepared. And I think that's what I've tried to get my message across, even though it has certainly been too early, albeit that The Big Short that you've maybe read or have seen, they were very early. They had to have deep pockets, but by gee, they were right in the end. So if we just backtrack, last year I was able to wing this type of this address because I'd had a lot of practice in the weeks prior, seeing clients in Melbourne and Perth, and had got it down to a reasonably fine art. But we're doing the Melbourne-Perth thing next week, and so you're my guinea pig. If we can just backtrack and just see where we've come from, because no one can foretell the future. Because if they could, then all the fortune tellers and psychics would be squillionaires. And they're not. But history does have a tendency of repeating itself. And if we can just have a very, very quick history lesson, I am going to have to refer, unfortunately, to a couple of my notes, but maybe we'll just see how we go. So is a picture of what's happened in the last 12 years. And so what I want to do is that we've all heard of the strategies, time in the market versus timing the market. And there's an arm wrestle as to whether or not, you should embrace either one. Morningstar believe that we try to help active managers, not passive managers, albeit that we have a lot of research on passive managed vehicles, probably the most in Australia. But we service active managers. We just want to stimulate all you guys out there and girls, and so that we won't end up in the dementia home. So what if time heals all wounds and time in the market? So if we go back, I don't know how to run these things. If we went back to 2007 and bought a vanilla ETF on any one of those four indices, which is the ASX 200, the ASX 200 accumulation, S&P 500 and NASDAQ, and you bought it at the absolute worst time, right there, late October 2007. Had you held it to today, your return on the ASX 200 was 2%. The ASX accumulation index, 200 accumulation index, showing the benefit of reinvesting dividends, was up 72%. The S&P's up 93%. The NASDAQ is up 190%. Now, if you were real smart, and of course all you people are, if you timed the market and bought 18 months later, in March 2009, then those numbers that I just said, 2, 72, 93 and 190, become 118, 240, 350 and NASDAQ 560. I suggest we think about being a little bit active. The risk is higher, obviously. Fear of, FOMO is there. But the rewards are very high. And I'm not saying you should be, we're never all in the market, some people are, all in the market or all out of the market. But you are allowed to, I think, have some passive and active equity strategies. And the combination of both would deliver you somewhere between those two extremes. And they are big numbers, the top and bottom. So that's what's happened. And is it likely that that type of thing can continue, given what forces and unsustainable forces have been at work to drive that, to drive that NASDAQ, what did I say, 190, 560%. And we all know why this has happened, because, interest rates are where they are. There's been $18 trillion US dollars of money printed. And that's been absorbed because that's what it's there for. And now the other side of the coin is record corporate and record government debt. These forces are unsustainable. We know that they haven't worked, and unbeknownst to some of them, that's your average annual growth in GDP in the US system. going back to 1950, of all the expansions and contractions we've had, given that we've got interest rate, the stimulus has been unprecedented in terms of price and monetary policy, plus printing of money. Where the markets would be if they didn't do it, goodness only knows. But you can see that the longest is this in duration, but it also is the lowest in terms of growth. Well, has it been worth it? Well, as I said, the question is, where would it be without it? And that's a question, we can all pontificate about, but I don't know. The other thing that's unusual about that decade we've just had is that if you had a roughly even spread of bonds and equities, both of them would have returned you significant gains. Now, that is also unusual, because if you look here at the most recent situation, so this last year, this is what's happened to the 10-year treasuries in the US, bang to bang. It's the first time, only recently, but this is only a 10, this is a 10, but it's the first time ever that the 30-year bond went under 2%. Last week, Greece issued bonds with a negative coupon. If you don't think we're in trouble, and the security is the bloody Acropolis. I don't know. So, this is if that's not unsustainable, I'll give it away. But in that period, what happened is the bond yields are doing this. Of course, the bond prices are doing this. But what are the equity prices doing at the same time? They're doing this as well. So if you go back here, this is the same thing that happened. The only time that yields went north and equities went south in a traditional way was back here, but every other down thing, equities went up with bond prices. Unsustainable. It's either saying that the lower for longer is correct, and the flip side of lower for longer in terms of interest rates is lower for longer growth. You can't have low interest rates or low bond rates, which are suggesting little or no inflation, but also little or no growth, and GDP going through the roof. It doesn't happen. And when central banks have done what they've done, investors simplistically take it at face value. They say they're cut. That's good news. Stimulus, GDP growth, corporate earnings growth, higher equity prices, everyone's happy. But no one few people go to the second level and say, hang on, why are they cutting? Well, that's the question that should be asked. If you go back to September 2007, the month after Bear Stearns went into bankruptcy, the Fed cut interest rates by 50 basis points. And you know that it's usually a 25-point thing, 50 basis points. You should have said, well, what are they scared of? It's like just going to the doctor. So, Wandsy, how are you going? I said, not too bad. He said, I just want to give you I'll give you a whooping cough needle or a what do you need? Stick one in your arm. And it comes out with a little syringe like this. But this time, he comes out with a bloody syringe this big and sticks it in your arm. What do you say? Well, that's all right, don't worry about it. He said, what are you doing that for? He said, is there something more than you're not telling me? So what is happening out there is, as I keep saying, is it's certainly not normal, and it hasn't worked to the point where they want to create growth, jobs. They've done the job things worked and what have you, but it hasn't created too much growth. And in overlaying that's been monetary policy. You know, the Oval Office has hit that US economy in particular with a fiscal bloody jab that, you know, makes your eyes water. Of course, it's all unfunded, but still and all, they did it. And there was, you know, 3 or 4 trillion of tax cuts and this and that. And you got the sugar hit last year, right? That second quarter GDP had just a 4 in front of it. But since then, the GDP has just gone boom, 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 boom. And the quarter that's just finished, the Atlanta Fed's print, which is the early warning one, they've just upgraded it actually from 1.7 to 1.8%. You know, we've had all this, you know, liquidity and, you know, money for nothing and all that, and it hasn't done anything. So where do we go from here? Where do we go from here? I've got to have a peek and see where we go. Because I've just talked about the decade gone, I've talked about the time in the market and the unusual behaviour. I really do think that we have to think about the behaviour of the central banks, because I don't think they know. I mean, what you've got at the moment in racing vernacular, and of course Caulfield Cup's on, you know, Saturday, and the Melbourne Cup's a couple of weeks' time, and the Everest is on Saturday, or what have you. So in what the market wants you to do, and Tom Waterhouse is my neighbour, he'll take you on. They want you to back a horse trained by Jay Powell and ridden by D. Trump. That's what they want you to do. Tell me, well, am I missing something? Because everyone, you know, Donald thinks that if I tweet enough and I do it when the market's going down, it'll get the market going up and what have you. He's besotted with the level of the Dow or whatever it is. He doesn't understand, well, I don't think he understands that, yes, there has been a lot of wealth created in that period, that 2009, whatever, I mean, that, and so that's where a bucket load of wealth has been created, but it hasn't been equally distributed. I suggest it's not even the 80-20 rule isn't even working. I think it could be 90-10. You know, so that is not conducive to harmony at all. And that's why, with all that wealth that's been created, you can't spend wealth. You can't spend unrealised capital gains. It can influence what you do, your spending habits. You can only spend cash. You can only spend income, or cash, i.e. income and debt. But that's what you spend. Now, if all these things are so good, how come the consumer is not spending anything? Because he hasn't got anything. 80% of the workforce in the US is living paycheck to paycheck. And I suspect that's the same here. Despite the fact that you have interest rates where they are and what have you, confidence is that there's very little confidence out there. Despite the fact that there's been trillions made, the consumer is still very, very gun shy. And he's 65 to 70% of the economy. Despite business has done nothing. Business has gone on holidays. Since 2010, you've had a little blip in terms of what they spent. This is CapEx, business CapEx in the US. They've done nothing. Free cash flow has gone here and here, dividends and buybacks. You can't create growth if you're not investing. And that money there, which has been made over the last decade, has been made by hedge funds and super funds and da-da-da-da. It's not in the economy. It is not circulated. And if you haven't got if your velocity of circulation doesn't work, you are going nowhere. You've got a huge pond of liquidity that you've never seen before. It's basically stagnant. And you go and have a look at a pond that's stagnant, what happens? There is no vegetation life. There's no life in it. There's no oxygen. There's no nothing in it. And that's what you have now. You have a huge pond of liquidity. On the other side, a huge level of debt, which has to be monetised at some stage. Ipso facto, I think there's going to be a paradigm shift. And in Australia, nothing it's the same. There's business investment as a share of nominal GDP in Australia. And good old Phil Lowe, he wants you, despite the highest level of uncertainty you've ever seen before, basically because of tweets, he wants you consumers and business to go out and go for it. Spend up big. Well, there's no way in the world. We're not that stupid, you know what I mean? Well, I think we are. And therefore, I don't know where they're going to get the growth from or the drivers of growth. I know what I would do. Don't forget, all you people out there, you and me, you baby boomers, don't forget we created the biggest growth that the world's seen between 1960 and 2000, because the workforce exploded from the post-Second World War baby boom. GDP growth is the combination of the change in workforce plus the change in productivity. It's output. It can't be anything else. It can't be anything else. If your workforce is not increasing by numbers, in other words, hours worked and productivity, blah, 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 that's what GDP is. Well, I'm sorry, because of what's happened, demographics are changing. The ageing population, we're all retiring. We're all retired. It's the fastest growing age group in the world, basically, is us. In fact, we are basically a cause of all these low interest rates, they tell me, because you're not spending, you're saving more, you're not consuming anything. It's your bloody fault, not the millennials. Don't get me wrong. The bloody millennials, they're right. Pay, what is it? Buy now, pay later. You hear these demonstrations. What do we want? More wages. When do we want it? Now. What do you want? Trees cut down. When do you want it? Now. Millennials? What do we want? A new handbag. When do we want it? Now. When do you want to pay for it? Later. I mean, the biggest buy now, pay later thing I've ever seen is the HEX thing. Have you seen this HEX thing? She's only 55 billion now. That's millennials, pay later. Did any one of you guys with grey hair out there get your fees paid for, or the this and that? When you went through uni, you paid for it yourself and you got out and you didn't know anyone in it. But put it on the Never Never. Well, that Never Never is going to come and get you and bite you. Now, I want questions of at least 15 minutes, and so I've now only got bloody 1 minute to go. Bloody hell. I tell you what I want you to do, because you read what I write, and you can, and that's why it's on paper. Sometimes you can do what you like with it. I want to read something to you, paraphrase you something, and I want you to see if you can pick the decade. Right. The decade was, for most of the part, the opposite of the previous decade, which they are. right, which they normally are. If you go back and have a look, for the last 100 years, have a look at go and get what Ray Dalio, Bridgewater's thing, and Google his paradigm shift and just get it. And it started, bursting reactions to high levels of indebtedness and the markets discounting relatively high growth rates. This debt crisis and plunge in economic activity led to aggressive easing by the Fed that consisted of interest rates hitting zero, printing a lot of money and devaluing the dollar, which was accompanied by rises in gold prices, stock prices and commodity prices. Because the monetary policy caused asset prices to rise and because compensation didn't keep up, the wealth gap widened and conflict between socialists and capitalists emerged. And there was a rise of populism and nationalism globally. When the Fed... Does that ring a bell? Yeah. When the Fed and fiscal policies were tightened, the stock market and economies plunged. Any guesses of what decade that was? 2020? 1930. The big gap, the big run was 32 to 37, and then hooray, what? Be prepared. I think it's going to happen again. Now, I've only got 14 minutes, and I think you should all be prepared. I'm probably way early still, but still I want you to be ready for it. Questions?
All right. We've got a good one here for you. So, Peter, you are elected Prime Minister. What is the first change you'd make to impact economic growth?
I'd check the votes. And the ballot paper, because I wasn't on it. Look, first of all, I wouldn't be running surpluses. The economy is below growth. Everything is below trend, no matter where you look, bar risk asset prices, and more so equity prices, which are being inflated by low interest rates and therefore the low discount rate, which all it does is bring forward future returns. The lower, I think last week, or I think I wrote about the seesaw. So, you know, when that's up high, when this is up high, there's a chance that when you hit there, it's going to be hard. When markets are out of equilibrium, you're in danger. So what would I do? Look, we have to get the economy moving. We have to get consumers to spend, but we can't get them more into debt because they're already up here. Generally speaking, right? There are plenty of people that haven't got debt, and that's, if everyone was the same, it'd be pretty boring. So how do you do that? Well, you've got to cut government expenditure. That is ongoing expenditure, not capital expenditure. You've got to cut that. Canberra has cost us $160 billion a year. If I couldn't slice a few quid off that, I'd give it away. And you have to put it straight back into the hands of the consumer. You have to cut tax rates substantially. You've got to boost disposable income, and then it can be spent. Because I keep saying, you can only spend cash, which is income, and or if you have to borrow, right? But that's 65 to 70% of the input into GDP. You can't rely on net exports. So don't extrapolate from either down there or up here. And it doesn't matter which country it is, whether it's Australia, the world's quarry, or China, or what have you. Net exports mean very, very little on average, to contribution to GDP. Investment, so the combination has got to be consumption and investment. You've got to get those two things right. And if we're so far behind the curve on infrastructure, and we've got to get in front, well, I do a deal with China. Say, listen, we want to build this. We're going to go borrow $1 trillion at, 20 basis points, which you can do, and then say, listen, Z, do me a favour. Send me over 500,000 of your workers so that we can get the bloody thing done this year, not in 10 years' time. And then then you've got half a chance. So that's what I do. It's money in where it's spent. You've got to do that. If you don't do that, I shouldn't have been elected.
All right. So maybe a role you feel a little more comfortable in. A couple of questions about what you would do. You talked about the 1930s potential. The word that was used in the question was depression ahead. So there's been a couple of questions about what would you do? How would you structure your portfolio? What would your reaction be to a downturn? Well,
look, as I say, you shouldn't be all out or all in. I'm not saying you should be half pregnant either, but the thing is, what you've got to do is diversification by asset class. So, and cash is an asset class. It's not a balancing item anymore. And despite the fact that you're getting nothing on your cash, it also gives you a peace of mind, albeit that you're anxious that you're not getting any return on it. But there are other ways of getting some return on cash, but there is a slight risk, right? Now, so I think you have to be, as I said, you have to be prepared. And so if you're prepared, then you have a plan, you have a strategy to be able to act and react to any particular deck of hand of cards you're dealt with. So that, but if you haven't got cash, you can't. Your optionality is squeezed. You have to sell something to buy something, and that's not usually, you know what'll happen. The one you sell to buy the one, that'll go down and this will go up. So you don't want to be in that situation. So I think I certainly wouldn't be. How can you possibly buy a negative yielding bond? If you do that, you would think that the yield's going even further down. That's the only way, but that's the only reason you're buying a bond at zero. You think it's going to go below zero. Well, I don't think. Seems to be a pretty ordinary bloody investment strategy to me. But I am different, I must admit. Look, I think we've got moat companies. I think you've got to stay there. It's all about sustainability. What did I say before? They're unsustainable. You've got to make sure that you have got sustainable assets that provide you with a reasonable income and a return that is at least acknowledges the risk you are taking. I don't believe markets where they are today are giving you that return for the risk you're taking at this point in time. I hear 5% dividend yield. I'm not convinced that, let's say, a REIT that's giving you a 5% dividend distribution yield, selling at a premium to its net tangible assets, is a good place to hide. Because when the interest rates go up and the discount rate goes up, that valuation, which is driven by those low discount rates, will go bang. And you know what happens, you've all been on seesaws, when that bloody thing happens and there's, free fall. Be careful in that space. And everyone, I think they said this morning, I'm quite happy with the commercial real estate and I'm quite happy with industrial, but I'm a bit scared about retail. Well, You're scared about retail because the consumer's got no money. You're not spending it, so why? He's exactly right. Mind you, that's where the bargains could be. Because at some stage they will get the consumer to spend again. But it might take a little while. Because that may well be where the value is hiding, is in those sold-out retail REITs, not in the overvalued commercial property. Has everyone been to Melbourne in the last 6 months? The amount of office space that come on in Melbourne in the next 2 years will blow your mind. In fact, it's probably bigger than bloody Geelong. And that's only in Bourke Street. I mean, I don't want to hide that. So I think it's got to be a balance and it's diversified, and it's international and domestic across those spaces.
Great. Why don't we do a couple questions from the audience? So put up your hand if anyone has a question. There we go.
Peter, I'll just answer the first question for you. The first thing you do is declare yourself PM for life.
Yeah, well, George, that ain't going to happen. They don't pay enough. And I'm not asking for $1 million either.
Thank you, Peter. Thank you for a good presentation. Peter, what influence do you think that Donald Trump will have on the economy while he tries to win the next election in the United States?
Well, you'll be on the edge of your seat or bed because this guy, I mean, he's been voted in, and good luck to them over there, but he is so unpredictable and so focused on one thing. Don't forget his background is real estate and leverage. That frightens the hell out of me. And that's why he wants interest rates down here, so that Trump Corporation can borrow a truckload of money at no interest rates. And he's building, don't worry, he's building his portfolio. Personally, I think he didn't give a nick about the great American, the patriots of, farmers and all that crap. It's wholly and solely him. If it wasn't, how come 50 of his best buddies have all gone through the bloody West Wing? It's like a bloody chopper. You could get killed in there. That door is going. I mean, so no, so I think he is dangerous for stability in financial markets because he can't help himself. If it's not going well, he'll tweet, he'll make something up. The markets, Wall Street, bloody love him. They just say thank you, and then next minute, bang, it hasn't happened. I mean, the phase one thing is a classic example last weekend. I said that's what would happen 2 weeks ago. I said I didn't, can't predict the future, but that thing you can predict. He will tweet and keep tweeting, and he will continue to tell porkies. I mean, so I'd be very, very careful. And there's a good chance you've got him for another 5 years. Better than even chance. I think the trade war with China will still be going when if he gets in for another 4 years, when he says goodbye in 2024. It won't be solved in that period, in my opinion. The Chinese will not let him do it.
All right, got a question in the front.
Given that Stephen Roach is right, and that Trump has no substantive evidence to justify his trade war, and that he's only got one aim, and that is to get re-elected, then what follows from that, just to extend on the previous question?
Yeah, well, I mean, it's very, very difficult. I mean, put yourself in Apple's position. He starts a war. Well, I'm not saying he fired a bullet, and it started a bit of a argy-bargy. Now, Apple is in a relatively unique position, but it has 59 factories throughout the world manufacturing these things, whatever you call them, mobiles. 59. 52 of them are in China. 52 out of 59 are in China. They employ 1 million people and they put out 600,000 devices a day. Where does he... And he says, come back to America. Come back to America. Get rid of China. Close down all that. Is he kidding? Could you think, and there's no country in the world that could accommodate that situation? 52 here, 52 there, employ 1 million. That's crap, to put it mildly. I mean, the guy's in fairyland. You know, and, you know, you hear about, you know, Goldilocks this and Goldilocks that. They're all fairy tales. Oh, it's not too hot, not too cold. Well, I can tell you what, they will get hot and they will get cold. And fairy tales are fairy tales. But still at all, he is a bad fairy tale. I don't think there's a good ending, in my opinion, he is a disruptor. He is the Amazon of global political life. In my opinion. That's not Morningstar's opinion, that's my opinion. Heaven forbid, if I was saying this in Chicago, they'd have me. I suspect. But that's, you know, I've got an opinion and they say, well, Hornsey, don't just say that, but don't get us in jail.
Great, so we are unfortunately out of time, but Peter, thank you very much, and everyone could please thank Peter with me.
Thanks. Thanks, Mark.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.